Hi, and welcome to episode 9 of How to Beat Nick. Today we're going to talk about venture capital and private equity. Firstly, if you don't know what these things are, you kind of need to learn. The central thesis is both of these firms buy private companies, so they primarily invest in companies that aren't listed on the stock exchange. They take substantial positions, usually more than 10%, of these companies, and they run them as active or semi-active investors. So they tend to sit on the board, have oversight into management decisions, etc., etc. The big difference between private equity and venture capital is that venture capital focuses mostly on smaller tech startups that are seen as very high growth. And the goal of a venture capital company is to hit it big with one or two portfolio companies. Those will kind of pay off the entire portfolio. Private equity is a little different. They traditionally invest in more capital heavy, capital intensive industries. They buy companies that have a lot of assets. And what they do is they use those assets to underwrite debt that they use to lever up the purchase. So, for example, a venture capital company wants to buy 10% of a new tech startup. They have to pay $1 million for it. A private equity company is trying to buy into a big industrials companies with $1 billion. Private equity company doesn't have $1 billion. They've only got $1 million. So what they do is they say, okay, we're going to LBO this bad boy. We're going to put up our $1 million, take out a loan for $10 million, and buy 10% of this company. And the bank agrees to that because they know that 10% of this company is a very good asset and likely will justify the loan. There are 3 arguments of salience with respect to VC and PE. The first is that a lot of PE is shifting away from private equity into private credit. And the reason for this is simple. Interest rates have gone up. When interest rates go up, the cost of debt goes up and the relative cost of equity goes down. What this means is it's easier for a private equity firm to issue debt at high interest rates than it is to try and take on debt at those same high interest rates. Which is why if you follow the news, you'll see that a lot of private equity firms are actually just private investment firms that are shifting toward private credit as a primary market. The second way to think about this is the problem of complexity, which is when you're debating this in an APTA context, your judge is not going to be smart enough to understand a lot of the nuanced finance. Nick isn't going to have AR break out an LBO to show the judge. So you have to understand the kind of small brain arguments on the topic. And the last thing you need to do is you need to explain those arguments from first principles. So don't just assert these things, really over-warrant the reason that your argument links to the debate. Just because judges are really not going to understand what's going on unless you do that high degree of explanatory work. With that, I think there are 3 small brain arguments that you need to understand. The first is the argument about consumer outcomes. Basically, the thesis of private equity and the thesis of venture capital is if we give money to these companies, they will start doing good things. Generally, that involves benefits to the customer, either cheaper products or more accessible products or better products. This is way more true of VC than it is of PE because VC firms invest in technology and those technologies do a lot of really good things. The fact that Google was funded by venture capital money meant that a lot of people got a lot of Google products. The fact that Facebook was funded by venture capital money meant that a lot of people got a lot of Facebook products really quickly. And you can actually impact this to a ballot very frequently. Like Facebook, WhatsApp's telecommunications network allowed people to message each other for really no cost. That's like nuts in terms of social value. And it probably outweighs almost any harm VC funding caused in the case of Facebook, just because it allowed them to deploy those products at scale and really quickly. So I think the first way to sidestep this debate is to talk about outcomes to consumers and why improving these companies leads to better consumer outcomes. The second argument is you can paint false comparatives. So very often, the false comparative to a VC fund is a strategic acquisition by a large tech company. If KKR doesn't invest in this startup, Google will buy them. And you can make the argument that Google, unlike KKR, will shit can the product because it's potentially competitive with the Google product, which is bad. Obviously, it's bad for the consumer. In the case of private equity, you can create false dichotomies between private equity funds and distressed debt funds or vulture funds, or you just make up the name. Judges aren't going to know. And basically what you say is, look, a private equity company might be bad, right? They might cut jobs, they might union bust, they might be bad. But you know what's really bad? A distressed debt fund. Because those guys do all of that but worse. And the third and final argument you can make is just like monopolization in this space doesn't exist. It's actually structurally impossible for monopolization to exist. Because what basically happens is, if there is a monopoly, right, if KKR becomes a monopoly in the space, a bunch of KKR principals leave and they start their own firm, and then they start competing. And the reason this works is, like, yeah, people try non-compete contracts, this, that, yada, yada, yada. The reason this works is, at the end of the day, there is just a lot of capital that wants to invest in these markets, and there are very few people capable of making good decisions. And so those good people really can kind of write checks and start their own competitive companies. And this happens very frequently, to the point where people have kind of given up on meaningful non-competes and they just enforce a year of gardening leave. It helps that, for example, in California, long-term non-competes are banned. So any of the VC firms cannot stop their principals from leaving and starting their own funds, which makes it a pretty competitive marketplace, and kind of allows you to dodge the monopolization arguments because these monopolies crumble from within.